Inflation is running hot, and the answer just might be to cut interest rates.
Yeah, a lot of people are thinking the opposite, but I
Yep.
agree with you.
Yep.
Right?
It's an interesting time, but we're going to dive into these inflation numbers and show you guys what we're talking about.
Yeah, let's first take a look at the historicals. So obviously this is the year-over-year change in the CPI and shelter. So for a lot of you guys that are watching from a real estate standpoint, the CPI, shelter is all housing, all things housing. So as you can see, just a couple months ago, it was sitting at about 6%. I think it's actually gone down a little bit. It's like 5.7 today. But you can see this is what the Fed's watching right here. And this is why they increased rates, because they felt like that by doing that, it was going to actually make things better. But what's happened, as we all know, it's not. We have affordability problems. We have people not listing their houses. We have people that have stopped building, and we're going to get into all that. But it's the opposite.
Yeah, so let's take a step back here. So let's look at the inflation numbers just in general. So, Jerry, you can take that down for us. The core inflation rose 3.8% this time around. But if you look at shelter's the highest, shelter and energy, but shelter came in at 5.7%, which is just down a little bit since January, but way higher than that 2% mark that the Fed is aiming for. And the reason shelter is such a big deal to the Fed is that it's 1/3 of the CPI, and it's 40% of the core inflation numbers. So that makes shelter very, very important to get down. So the problem with the shelter numbers, as we talk about on this channel, is the supply issue, right? Because we don't have a supply of houses.
Yeah, let's show that chart real quick. So, Jerry, if you go to the chart that shows the supply. So let's go to the other one first. So this is the housing completions by year. So you've got the single family in red, the 2 to 4 units, 5 plus, so that would be the multifamily. So that would be 100 units, 200 units, etc. And then you got manufactured homes. Now, what's interesting here is that you guys can see what happened during the crash in 08, 9, and 10. That I was right in the middle of that. And we saw, obviously, the banks pulled back and investors pulled back, and people started to, everyone started to pull back. And what happened is nobody started building. And this is the big issue. At that point, if you look, it's just like climbing stairs here. Each year it got up a little bit better than the prior year as the economy started getting a little bit better. Now, don't forget, in 2010, we were also had a huge amount of supply of homes on the MLS.
Right.
So on the single family side, we also had a lot of listed units, a lot of bank-owned units, etc. So call it 2008, 2009, 2010 was really a problem. And so we've spent the last 10 years kind of working through that. Now, what we haven't talked about yet is population. So what's happened during the population during this period of time? Well, most of you probably know it's grown. And that puts stress on units, things like, births minus deaths. And of course, now the big hot topic is immigration. So Jerry, let's go to the next one. So this is very interesting because you have existing housing units relative to population demand. Now, this is a couple of years old, but some people say it's higher, but it was at 3.2 million units short, essentially, based on the amount of people, births minus deaths, plus immigration. And, of course, I think it's probably gotten even worse. It's somewhere between 3 and 5 million. It depends on who says it. So the National Home Builders have a different number than Realtor.com. So everybody's got a little bit different. This is the Census Bureau and Moody's. So this is the problem we have. We have a supply problem, and that's creating, when there's low supply of anything, guys, it creates price increases.
Right, because there's just not enough. And so
Jerry.
the response should be, how do we increase supply? Well, they made perhaps an error when they lowered interest rates so much and let everybody refinance. So everyone's sitting in, 3, 4, 5% mortgages, mostly like 3 and 4% mortgages. So if a family wants to sell and move, or even like my parents who are looking like, should we downgrade with retirement? It doesn't really make sense because their housing payment on something is going to be the same amount, even if it's smaller. So nobody wants to sell. So the only way you're going to up supply, there's two ways. One is through building more units, and the second is going to be through lowering the interest rate so that people that are at a 4% interest rate, they can probably stomach a 5% interest rate, but they can't stomach an 8% interest rate, right? So that's where the Fed is at. And I think
let's don't forget about new construction, because as rates go up, people stop building, like myself. As you guys know, we're building multifamily. So we put a whole bunch of projects on the shelf because the cost to build is somewhere between 8 and 10%.
Right.
And so that's additional supply that would have normally hit the market. And so what you guys are seeing right now is supply that started 2 years ago. That's what's hitting the market today. I'm talking about all kinds of stuff, right? Single family, condos, multifamily, all of that. There's a time frame it takes to build and a time frame it takes to lease up. So that's all hitting the market as we speak.
Right. And it's, the Fed does not look at this as their duty to worry about the supply problem, because that's not really like they've always controlled everything through interest rates. And Jerome Powell even said there's a structural housing shortage in the United States, and that's really a longer run problem. The problem with high interest rates is a short run problem. The longer run problem is lack of supply of housing.
Right.
But he's not necessarily putting together that, in order to get more housing, you got to lower rates. And if that's the problem with lowering rates, is that you then create a bubble because all your other asset, your cars and, your car loans and cheap credit, like all of that also increases.
On one side, but not on the shelter side. So
Right.
let me tell you what's going on the shelter side. If you just look at shelter, which is why we started with that chart, I need 3, 4, 5% money in order to build affordably. So if somebody's going to build a $500,000 house and it costs 10% for 1 year to build, that's $50,000 that it costs that builder to build that house. 10% at $500,000. Let's just say that's passed on to the consumer. If the rate is 3% or 4%, obviously it's significantly less. So, and if you have a builder that's building 50, 100, 200 homes, that's significant. And we haven't even talked about the buyer, because now the buyers are in a position where, their rates are 7%, 8% in order to buy something. So as we all know, we've talked about it, and you guys have seen all these numbers, mortgage payments are, $1,000, $1,500 more a month. So people are they're just sitting on these low interest deals that they have. They're not going to move. It's created a supply problem with MLS. So remember the chart I showed you a minute ago, when in 2010 we had a lot of units on the supply and the MLS. There was a lot of opportunities to pick from. When there's lots of supply, prices go down naturally. The market figures it out. And when there's not a lot of supply, then of course prices rise. And now you've tacked on the interest rate, which makes it even less affordable. So when you're looking at shelter, what the multifamily arena needs, what the single family arena needs, we need affordable housing. We need affordable housing. And how do we get affordable housing? We have to have affordable financing. That's it. There's no way to deliver affordability today. And once you're oversupplied in a market, if you're in the real estate game, you probably don't like it, because it's going to create price suppression, and it'll create rents from going flat or even negative. Whenever there's a lot of units being built in one area, for example, from the multifamily, we're always competing with all the other neighborhoods. That's just the way it is. And so that's better for the consumer. So if we're really talking about the consumer here, the rates need to go down so that people can add supply or refinance or start to buy again, because right now the shelter price is going to continue to run.
And you've even been seeing that in your own company, right? I mean, you guys are not, you were supposed to start more construction deals than you have, and you
correct.
put them on halt and everything else.
Well, I'll just give you guys a couple examples. So we have a couple projects under construction that one's a 330 unit building, so I'll just focus on that one. When we started, our construction loan was somewhere in the 4s. That's 4%. Okay, great deal. We loved it. Start building, and then rates started to tick up, as we all know. And now we're up in between the 8 and 9% range. Okay, so and the project's like $60 million. So all of a sudden, you can imagine we got 3, 4, 5% more on the construction loan because it's a floating loan. Because the banks won't, when it comes to construction, there's no collateral yet. So the construction loans are floating type debt. Now, obviously, we preach fixed rate debt, know your mortgage payment this year, next year, 10 years from now. You can't do that on new construction, and either is a builder. And so what's happened is just on that one deal, we went from positive cash flow to negative cash flow just on that one deal because of the interest rate, even though the rents went up and all that kind of stuff. And so builders have pulled back. They've had to pull back because the cost to build is so expensive.
And it's not just us saying this. You know, there's a lot of senators and everything. I wanted to read a couple quotes just because I think that it's interesting from their perspective. So Ayanna Pressley, who is a senator in Massachusetts, and she's a Democrat, says, obviously higher interest rates have raised costs for affordable housing developers, and many of them have chosen to slow down or halt construction entirely. So fewer homes are being built, which means fewer people are being housed. And then also you have... one of the advisors for JP Morgan said, you're not going to see meaningful downward pressure on shelter costs until the Fed lowers interest rates. Mortgages come down to a more reasonable level and supply comes back online. So we are very interested in what the Fed is going to do. We have a feeling they're going to just hold, but that may not work. And so it will be interesting to see when they start to cave and lower rates and maybe how quickly they lower rates, because if they really wrap their head around they can't control the shelter costs and they need to bring down the rate closer to what it was in 2021 in order to get more supply, then you may see it come down faster than we thought.
Well, we're creating a renter nation. That's essentially what we're doing. There's people cannot afford to buy a home and they cannot afford to trade out. So I have so many friends. I had a conversation this morning of a friend of mine that bought a place in Florida. And it was a teardown, essentially. He doesn't really want to remodel it. He wants to tear it down and build a new one. But he's not going to, because when he bought it, it had a 2.8% rate. So he just said, I'm just going to wait. I'm going to wait it out. And so there's so many stories like that, like my own, all my friends. You know, interest rates are a big, big piece of adding supply. And certainly it is the reason that the MLS is half the size that it's supposed to be historically.
Even Sherrod Brown from Ohio Democrat said, you're measuring inflation and treating everyone as renters, even though 2/3 of Americans are homeowners.
Yeah, that's what she told Powell.
That's what he told Powell.
He told Powell, yeah.
So it's interesting because are they treating everyone like renters because they know that that's what the future is going to be? Or is that,
the rents are supposed to be a place to build your credit and stair step into home ownership. That is the system. That's my place in the system. That's what multifamily is supposed to be. A lot of people do rent for a lifestyle, but things are really out of whack when renters can't save any money and they can't save for a down payment. And even if they could, what they used to save, now they're just priced out of the market because of the interest rates. If interest rates came down, it would be a lag, unfortunately. Now, on the other side of that, let's talk about the potential negatives. Low interest rates create bubbles, period. They do. But how can a low interest rate hurt somebody that has credit card debt? It just can't. It's only going to help those people, right? There are people that are one of the big industries to watch right now, guys, is auto body, auto paint, auto mechanics, because you know why? because people can't afford to trade their cars like they used to because interest rates are so expensive. And we're not even talking about the price of cars. They're staying in cars longer. They're driving them longer. Okay, so everything is moving that direction. It's the same way with housing. It's the same way with building. And I'm telling you, we're gonna see a very, very soft cushion this year. What you're seeing right now is a lag. It's 24-month-old stuff. It's all hitting now, and it's going to sprinkle into next year a little bit, and then after that, it's game over.
Yeah, Brad Sherman, a Democrat from California, said, I'm arguing that the Fed's annual target rate for inflation of 2% is too high. And my goal here is to convince you to cut more and sooner.
Yep.
And so I think why these are interesting points is it's not just us, as in the housing, developers saying that, right? These are real things for real people. And with people with credit card debt, it's almost like the economy has two sides, right? Because it's really the middle class is getting wiped out, right? So there's people that, own homes already, and they are in this real estate game, and they locked in these low rates. And then there's people that don't own a home, or they bought a home after 2021, 2022. They have higher rates. They're trying to keep up. The credit card interest rate is really high. Their housing mortgage is really high. They're waiting to refinance, or they don't own a home at all, and their rents are going up. And it's the high interest rates are it seems to be like holding the rates high or hurting the people that are lower on that totem pole more than it's hurting those at the top of it.
It's stopping all momentum. That's essentially what's happened. Everybody's stopped, right? Everybody's like, okay, how much cash do I have? If you guys look at savings rates, we've pulled this up plenty of times. We have plenty of videos on this. Personal savings rates went straight down like a hockey stick after the pandemic, after a lot of people got a lot of money during that period of time. Guess what's at an all-time high? Credit card defaults. So people are defaulting. So these are red flags that you guys need to pay attention to. So these are people that own homes. These are people that own cars. These are people that are your renters. And they're in trouble. And things are more expensive. And I'm telling you, there's like an 18-month window, and then rents are going to go like this, and there's no relief for house prices right now at all, because the way to do it, as George would say, also the cure for high prices is high prices. One of the things that you will start to see it temper off, but this is what's happening right now, is there's less consumption, less buying, less refinancing, less building. And, let's just face it, that's what the Fed wanted. And that's how we got inflation down from over 9% to, let's call it in the mid threes right now. At least that's what they're reporting. So what's happening is, if you take a look at the inflation charts, some things are actually coming back down to earth, which is good. But shelter isn't one of them. And I'm telling you guys that what the potential is rates might go up. Mm-hmm. Rates could go up the second half of this year. Now, I know this. It's amazing to me that we've just got it to just above neutral. I think the neutral rate, but they could go up. They could go up if shelter, which is the exact opposite of what needs to happen. Because then what's going to happen is banks are going to pull back, and developers are going to pull back, and the people are still going to be sitting in these low interest rates. There's going to be no. Think of the mortgage. Think of the title. Think of the builders. Think of the subcontractors. Think of all the people that are in the real estate space. They're on the shelf right now, right?
Yeah, and a couple interesting comments from YouTube. German says, a buddy of mine who's a repo man has an overflowing lot of repossessed vehicles, as it started in late 2022.
Yeah.
And so that is happening because people can't afford their car payments, and their car payments are just too expensive. Henry said, I understand interest is affecting everything, but I'm old enough to remember paying 11.5% back in the 80s. I just don't think rates are too high.
Yeah.
So what do you say to that?
That's a heck of a point. Okay. Mm-hmm. If you look at year-over-year averages, I would say that you're accurate. Right now, rates are about what I my whole career is based on. But you also have to look at price and supply. So we have a bunch of different factors happening. So what drives real estate really? In my opinion, I would say that it's population growth. Population growth, and because if you don't have people, then the developer, there's always a lag, right? So what happens is prices go up, and developers rush in and they go, oh, we're going to build in this area because prices are going up, and then they add a bunch of supply, and then prices come back down. So I agree with you that in the 80s, the dynamics were very, very, very different. Jerry, if you go back to that one chart, the population growth and supply, we can actually look at this from the 80s. So take a look. As you can see, as it relates to population growth through the 80s into the 90s, it was actually in pretty darn good shape. And it was the same way. This is the run that happened from 2000 to 2007, 2008. So what you had at this time was did not have a supply problem. So in the 80s, the shaded beige area, that means excess supply. That means that prices are stabilizing. All the way to the right, that's a deficit. So the difference is, and I agree with you. So in the 80s, when you have high supply, you could actually raise rates. And the same thing in the 2000s, because you have enough supply. You have supply, and you're still going to be fine. Right now we have high rates as compared to 2 years ago, and we have a massive deficit.
So let me kind of break down what you just said, because I think it's really interesting. So basically, we had a lot of supply. So with the high rates, there was price competition.
Correct.
Right? So like you could kind of gauge, okay, I'm going to be paying 11%,
right,
but I'm only going to pay this much. And there was enough supply that it could keep prices stabilized.
Right. This is a supply issue, guys. I'm telling you. And then the other side of it, of course, is, who consumes those? Well, renters and buyers. And those are real people. So, and there are real people that are aging out, getting out of their house, getting into the jobs, getting a career or whatever it is, or graduating from college. All you got to do is follow that. You can see that this actually is part of the issue. Then, of course, the Fed lowers rates, which is exactly what they did with Bush. He said everyone needs their own home, which is totally fine. And they had all these crazy programs, and that all happened in the early 2000s, because I was in the middle of this, and everybody went out and started doing the same kind of stuff. And then next thing you know, Obama got the backside of that, unfortunately, because then it started to bust. Because essentially they used the low interest rates for people just to consume. And then that's what happened. And so all that inventory hit, and then the banks backed down. This is a supply problem. The population growth, I think year over year, has been pretty steady. Actually, I think it's actually been kind of flat in the last couple of years, to be honest. But if you take a look, we need more housing. We need enough housing to match the population. And right now we're somewhere between 3 and 4 million short.
Awesome. Well, thank you guys for tuning in. We will see you next week, and make sure you sign up for Ken Pro.
See you guys.